Our Montaka strategy passed its 3-year anniversary on June 30, 2018, and we are delighted by the results we have delivered our investors to date. As you can see, an investor who put money into the Montaka Global Fund on the 1st of July 2015 would be 37% better off today. And this is the net return after all fees. Now, while this is a solid return, some of you might be making the observation that 37% is good, but over the same period, the MSCI World Total Return Index in Australian dollar terms increased by 32%. So Montaka's outperformance is relatively modest. Is this right? Well, this is actually not an apples to apples comparison. You see, in Montaka, we actively manage 2 portfolios of stocks instead of 1. Our long portfolio is the same high conviction portfolio of undervalued, high quality global businesses that underpins the Montgomery Global Fund and the Montgomery Global Equities Fund. But in addition, we manage an independent short portfolio in parallel. This is a portfolio of deteriorating, misperceived, overvalued businesses with asymmetric risks to the downside. And in this portfolio, we generate profits for investors when stock prices fall. Now, what this means is that Montaka operates with a significantly reduced net exposure to the overall equity market. Essentially, the shorts offset the longs. Not entirely, but enough to reduce the market risk of Montaka by approximately 2/3. So coming back to Montaka's performance over its first 3 years, the chart showing illustrates how Montaka performed relative to a risk equivalent version of the global equity market. And as you can see, the difference is stark. So what we are essentially trying to achieve with Montaka is to participate as much as possible in market upturns, but significantly reduce the negative impact from market downturns. And this is exactly what we have achieved over the first 3 years of the strategy. As shown in the chart, Montaka's first 3 years can be characterised by a global equity market that delivered 1 down year, followed by 2 up years, represented by the black bars. And as you can see, in the down year, Montaka, which is represented by the red bars, avoided the downturn and even added a modest positive return. Then on the 2 up years, we've basically kept pace with the market. Now, hypothetically, if you had the ability to capture 100% of the market in up years and completely avoid all the market down years, then a $1 million investment in the global market 20 years ago would be worth nearly $12 million today. This is significantly higher than simply investing $1 million in the global market itself, which would be worth about $4 million today. We call this compounding through downside protection. And you can really see how powerful it can be over long periods of time. As we look out to the year ahead, we would not be surprised if volatility picked up somewhat. Tensions between the US and China, combined with normalising global monetary policies, creates conditions for a few bumps in the road ahead. And should volatility pick up, well, this is nothing to worry about. Montaka is currently positioned with less than 40% net market exposure. Our low net should help dampen the impact of any volatility, and remember, it is during times of volatility that the market provides us the opportunities to buy great businesses at discount prices. So through this lens, some volatility can actually be viewed as a good thing. We are really proud of the performance we have been able to deliver our early Montaka investors to date, but rest assured, we believe our best days lie ahead.